Oh, Wendover vid. Wendover vid on private equity?
Private equity is a great idea, in theory. Funds take investor money, buy a bunch of fledgling or faltering companies, shuffle around their structure and leadership and operating model, grow their worth, then sell them a few years later for a profit. What's wrong with that? For example, do you remember Yahoo? In the early 2000s, it was an icon of the early internet. It was consistently worth more than Amazon and Apple combined.
That's so
Its
crazy.
market cap reached a high watermark of over $125 billion.
Crazy to imagine a world where Yahoo's bigger than Amazon and Apple combined.
But today, it's known for what it isn't. After rejecting a $44.6 billion purchase bid by Microsoft in 2008, a decade of decline led to its eventual sale to Verizon for a humiliating $4.8 billion. Verizon then merged the company with AOL, previously bought for $4.4 billion, but after the downward trend continued, Verizon finally sold the combined company for just $5 billion.
What's funny is like, it is a very low amount. They lost a lot of money, but it's also embarrassing for Verizon that they spent a combined $9 billion on AOL and Yahoo to try and make that money back. They couldn't. They had to fucking, I mean, that's just funny. It's like,
An enormous
it's still a bad
loss.
investment.
The buyer was Apollo Global Management, a behemoth private equity firm previously headed by Leon Black until his $158 million in payments to Jeffrey Epstein emerged in the media. Through the years, Apollo has owned and transformed companies like ADT, Chuck E. Cheese's, Qdoba, and AMC Theaters, but this time, they believed there was value to be had in the beleaguered web services company, Yahoo. For their strategy to work, they needed a leader, and for that they turned to experienced businessman Jim Lanzone. Part of the reasoning was surely that this wouldn't be the first time Lanzone attempted to turn around a faltering internet business. He made a name for himself while working at Ask.com. The company started as Ask Jeeves, an early and promising competitor in the search engine space focused on natural language processing, much like today's AI-driven chatbots. Google, of course, won that competition, so the company pivoted its business model to center on questions and answers rather than search, and correspondingly
I do remember, this is like very, very old now, but I do remember when there was still some debate when some people like teachers would be like, yeah, you could try Ask Jeeves.
rebranded as Ask.com. It was around then that Jim Lanzone was appointed CEO, and while always overshadowed by the company's fall from its promising early days, Lanzone was recognized as having finished his term as CEO with the company on firmer footing, and is therefore credited for its continued survival. In the years that followed, Lanzone went on to lead CBS's digital business leading up to its massive merger with Viacom, and then was briefly CEO of Tinder in 2020, so Apollo believed he had all the experience for the job. This new leadership team, CEO Lanzone and investor Apollo, started by selling off extraneous yet valuable assets Yahoo had acquired through the years.
Didn't Yahoo at one point own $30 billion of Alibaba stock? And it was worth more than the rest of the company? And they split it off? I don't know if this was Yahoo. I think it might have been, like it was an angel investment they'd made in Alibaba was worth more than everything else Yahoo had put together times 10. And they split it off to make Yahoo something.
Wanted to focus on the company's core rather than just acting as a collection of random revenue-creating resources that managed to survive through time. So the key assets of the comparatively strong...
It's kind of like how MicroStrategy is a publicly traded company, but like the company is literally worthless and it's just that they own a bunch of Bitcoin. So people are trading, and then somehow the company is like trading at a premium value for being a bundle of Bitcoin than what the Bitcoin's actually worth.
And independently operated Yahoo Japan were sold off to its other owner, SoftBank, for $1.6 billion. Then Edgecast, a streaming technology company that the former owner had grouped into the Yahoo AOL merger, was sold for $300 million. With just those two sales and the $2 billion they brought in, Apollo was reportedly able to more or less recoup what it had borrowed to finance the purchase of Yahoo in the first place. The key next step was facing reality. Recognizing that Yahoo was no longer truly a search engine, it was no longer an internet homepage, and it was hardly even an email provider anymore. Really, Yahoo was simply just...
One more thing on email providers. So There's early Drake and Lil Wayne songs. I found this out recently. I didn't know where this came from, but I knew the songs. Like around the So Far Gone Successful era, where Wayne would be on a track with Drake and he would say, yeah, it's Drizzy Drake Rogers. You know, he would shout him out. And I never knew what that nickname was. Why Drizzy Drake Rogers? And I found out during this beef that it was because his email was drizzydrake@rogers.net, and Rogers is a Canadian internet service provider. Like, I've known Drizzy Drake Rogers for fucking 15 years. And I only found out that he thought that was, like, Lil Wayne thought that was Drake's last name because of the email. That's fucking crazy.
Whatever still worked. And what worked was clear: Yahoo Finance and Yahoo Sports. Through the years, each had
Yahoo Sports
maintained
still works.
and gained a reputation as the best places to go for investing in sports, news, and data. So to double down on success, they once again hired from experience. Ryan Spoon's time at ESPN and BetMGM gave him context into the
like
fantasy
Big A
sports
Gmail.
audience that drives so much of Yahoo Sports' traffic, so he was tapped to be that division's president. Tapan Bhatt's time as chief product officer of NerdWallet informed his experience in the wants of the newest generation of retail investors, so he was appointed to general manager of Yahoo Finance. Structurally, within Yahoo, each of these core divisions was given a high degree of autonomy to build out unique product offerings for their specific customer bases. Yahoo Sports started work to bolster its sports betting offerings, including acquiring sector startup Wager in 2023. Yahoo Finance focused on growing its subscription-based offerings, and its Yahoo Finance Plus platform, offering advanced trading tools and data, is reported to now have more than 2 million customers and double-digit year-over-year growth.
It's insane.
The details of what Apollo and this new leadership team are doing go on and on, but in short, Yahoo has gone through a transformation marked by cutting off its appendages.
Who is paying for Yahoo Finance? And what possible advice or stats are you getting that you couldn't get elsewhere? It's good, but I don't pay for that shit. I mean,
Is reinforcing its core, and it's working. While obscured by the lack of reporting requirements due to its private ownership, all indications suggest that the company is, while smaller, as healthy as it's been in decades, and the CEO has said that it's on the path towards IPO and is, quote, very profitable. However Apollo exits this investment, it will almost certainly yield them a tremendous return. And it'd be fair to argue they will have deserved it. They came in, took a risk, found a new leadership team, developed a viable strategy, then shepherded the company through a transformation. They took an obsolete institution and brought it back into relevancy. And this is exactly what the private equity industry would like you to believe private equity is.
Mic drop.
Structurally, private equity firms are not complicated. Their cores are the general partner. General partners typically know the right people. It is not an entry-level job. To take the example of a rather random, rather unremarkable firm, J.W. Childs Associates was founded by general partner John W. Childs after a long and successful stint at Thomas H. Lee Partners, founded by Thomas H.
Are you telling me that private equity has a lot of old white rich dudes? Or is this the rare one? Is this the rare one? This is probably rare, okay. Just these two, these are the only two?
H. Lee.
That makes sense.
Thomas H. Lee founded his firm after a long stint at the First National Bank of Boston, where he rose to the rank of vice president.
Okay.
Other examples of private equity general partners include Mitt Romney of Bain Capital, who was...
These are the exceptions. Most private equity is Gen Z Latina women. That's what I figured. That's what I figured, honestly. I figured private equity is mostly Gen Z Latina women. That's like the core. Okay. And then it's also Mitt Romney.
Also the 2012 Republican nominee for president, and Steven Schwarzman of Blackstone, the 34th wealthiest person in the world. These connections are crucial thanks to step 2 in the process, raising money. Typically, general partners start by throwing in a couple million of their own money to set the stakes,
couple million.
then they'll go around pitching investors on why they're the best person to manage the investors' money. Often it has something to do with having particular experience in a particular industry that is particularly attractive for particular reasons. In the case of J.W. Childs, he likely went around arguing that he had a particular knack for investing in consumer food and beverage companies, since at his prior firm, he had helped arrange the buyout of Snapple for $135 million in 1992, which his firm sold 2 years later for $1.7 billion after massive revenue growth.
Sheesh.
And he'd likely argue that food and beverage companies are great for investment since people have to eat and drink, and therefore the sector is less subject to the cycles of the market than something like tech. This sort of stability is particularly attractive to the massive institutions that make up the core of private equity investors. In John W. Childs' case, insurance companies like Northwestern Mutual or employee pension funds like the Bayer Corporation Master Trust. Individuals can theoretically invest in PE funds, but only if they hold enormous wealth. It varies dramatically, but many funds have minimum investments upwards of 25.
So there's this thing going on right now. I probably should talk about it separately, but the Blackstone REIT, Real Estate Investment Trust, is clearly having some shakiness. They're clearly overvaluing the real estate properties they have under management to pretend to be doing better than they are. There's obviously some shadiness there. And one of the ways I was intrigued about this and looked more into it earlier on, there's more news now, but earlier on, is that they started sending offers to people like me that used to be you needed to put in $250,000 to even have a chance to be in it. And they were like, for a limited time only, we're allowing you to be in the Blackstone REIT for only 50 grand or whatever. They were doing like that, which is a surefire sign that they are desperate for quick cash. And it was during the time they were getting all these redemptions, people trying to pull their money out of the B REIT. It's, so there's definitely some, we'll look more into it, but it's, I would not touch that with a fucking 50-foot pole.
$1 million. Meanwhile, the way private equity firms themselves.
There's the pyramid scheme. It's more like with these, private equity real estate type funds is they sort of let's say they buy a building, like this building for $100 million. And then they say it's now worth $120 million. So they can report at the end of the year, we grew your wealth 20%. I give them money. They buy buildings with it. They say it moves up. But the buildings are not actually worth that, right? They choose what they're marked. So they don't have to market to market, which is say what it's actually worth in the real world. It's basically lying, fraud, whatever you want to say. And people are becoming wise to the fact that they have, hundreds of billions, trillions under management that may be all overvalued because buildings around their buildings are starting to sell at drastically lower prices. And they're like, no, ours is still worth more. It's structural advantage, but it's becoming obvious. So people are pulling their money out very quickly from this Blackstone Real Estate Investment Trust, and which is causing them to panic. And because if enough people do that, they have to start selling. And if they start selling them, then they have to market to market, and then that's the problem, So there's a definite house of cards here. I mean, you clip this because this is going to be probably major news within a soon period, maybe a year or two. I think it's going to be I think Blackstone's Real Estate Investment Trust, unless interest rates go to zero and everything moons again, I think there's going to be a music stopping moment.
Sells make money is remarkably consistent. They just take 2% of it. 2% of all money each year is taken as a fee, regardless of whether or not the firm actually grows the investment. But then to incentivize returns, the firm also sets a benchmark, called a hurdle, that they're aiming to beat in year-over-year investment growth, say 7%. Any money earned on top of that hurdle is then subject to a 20% fee that goes back to the firm.
20.
So say if a fund was originally worth $100 million but grew to $110 million, $3 million would be subject to that performance fee, and so 20% of it, $600,000, would go back to the firm. In practice, what's earned from the 2% base fee is fairly consistent since there are generally restrictions as to when investors can take money out of the fund, so the sum does not generally fluctuate rapidly. Therefore, firms typically earmark this base fee for covering basic operating costs like office rent and analyst salaries. But how much is made from that 20% fee varies enormously. Some years it could be nothing, others it could be yacht money, especially since the gains from that fee are generally distributed primarily to the general partner. This is how general partners like John W. Childs become billionaires. And even better, the money from these fees is not considered traditional income by the American tax authorities. It's considered capital gains.
Stupid.
Despite the fact that these earnings do not truly come from an investment by the general partners themselves, the IRS treats them as if they do, and therefore only about 20% goes to taxes versus the 37% they'd pay on traditional income. So, considering it's the primary source of their wealth, the general partner is massively incentivized to maximize their firm's gains, and to supercharge this to the next level, they almost all rely on one simple trick. They don't actually invest their own money, at least primarily. Now, if a $100 million fund bought a $100 million company and increased its value by 25%, they'd gain $25 million. But if a $100 million fund bought a $400 million company and increased its value by the same multiple, they'd gain $100 million. They'd 2x the fund's value. And believe it or not, a $100 million fund can buy a $400 million company as long as they have a friendly banker. This is what's referred to as a leveraged buyout. The fund puts in some of their money, but primarily relies on borrowed money to pay the seller, just like a home buyer with a mortgage. This magnifies the potential earnings, but in turn, of course, the potential losses. But it's worth considering what this does for the general partner. In a $100 million fund buying a $400 million company with 75% borrowed money.
Do you guys want to put all our money together? Do you guys want to put all our money together and leverage buyout? What should we buy out? Let's buy out Wetzel's Pretzels. Holy shit. Let's do it. Let's put all our money in, take out a massive amount of debt, leverage buy out Wetzel's Pretzels, and then just start fucking strip mining it for cash.
These small margins of growth can make all the difference for this one individual. With a 7% hurdle and 7.5% growth, 20% of the margin above 7% on that $400 million company would earn this individual $400,000. But if instead the company reached 7.75% growth, the general partner would earn $600,000. Because of this amplifying effect, every 0.25% growth, a rather small difference, earns the general partner another $200,000 in income. It's also worth considering that it really doesn't matter exactly how this value is created. For every miraculous Yahoo turnaround story, there's a Marsh Supermarkets. At no point did Marsh reach the size or level of national ubiquity as Yahoo. If you
Never heard
aren't
of
from
Marsh.
Indiana or Western Ohio, you've likely never heard of Marsh Supermarkets.
Yep.
Yet, while confined to just 2 states, Marsh Supermarkets and its private equity takeover exemplifies a pattern that spans all 50. The first Marsh opened here, a small local grocer catering to specific local needs in Muncie, Indiana in 1931. The simple concept took. Weathering the Great Depression, then outlasting World War II, the budding Indiana institution began to expand. By the 1950s, there were 16 Marsh locations across the state. By 1952, there was a Marsh distribution.
It's funny how many rich people come from opening grocery stores in the 30s. You know, all you have to do is put up some shelves and put canned beans on it. And all of a sudden you're fucking set for generations. Insane, dude. It's insane.
Distribution center in Yorktown, Indiana, and by 1956, the store was expanding into Ohio. As demands changed in the 60s, the company adjusted. Marsh Food Liners became Marsh Supermarkets, growing in size to accommodate one-stop shopping. Diversifying as decades progressed, the company also established its own convenience store, the Village Pantry, its own bargain bin store, Low Bill Foods, and eventually purchased its own upscale grocers in O'Malia Foods and Arthur's Fresh Market. Blanketing urban and suburban Indiana and Western Ohio, Marsh and Marsh Properties were a mainstay through the 90s and 2000s. And it was at about this time that Sun Capital became interested in the company. Today, there are 0 Marsh locations.
Well, there you go.
In 2017, unable to keep up with rent payments and struggling to pay vendors, the company filed for Chapter 7 bankruptcy, closing every last location and liquidating all remaining assets. Like an empire spread too thin, Marsh had reached its territorial epoch.
An empire spread too thin. It's grocery stores across Ohio and Indiana. It's not fucking Genghis Khan, bro. Like the great fucking Ozymandias.
Before collapsing in on itself within just 2 decades. All on a timeline that rather neatly lines up with the brand's time under Sun Capital's ownership. Now, Sun Capital Partners didn't instigate the regional grocer's fall from grace. Prior to the sale, Marsh had expensively failed to expand into Chicago, it had felt the revenue squeeze from encroaching box stores, and it watched Kroger's parade into its grocery market. In response, the company began to fall behind, failing to modernize its stores or products, backing out of sponsorship deals with the Indiana State Fair, and opening itself up to the possibility of selling. In an atmosphere of supermarket consolidation, though, there wasn't much interest in the struggling chain. Not until someone noticed in a footnote in the company's financial report that the company held a rather robust real estate portfolio. A $325 million purchase point then became more palatable, and in early 2006, Sun Capital jumped, paying $88 million in cash and assuming $237 million of debt. To Sun Capital, the deal was a can't-lose proposition. Either they'd turn around and flip a bloated business, or they'd sell the assets which just in real estate have been estimated to be worth $238 to $360 million. Under new ownership, things changed quickly. They paired management, they sold the company jet, and with the money saved, they renovated storefronts.
Okay.
Sales went up. Then came more maneuvering, but less the kind that would help bump sales. Almost immediately after Sun Capital took over, store locations went up for sale.
Zoom in
this
Google
one
Maps.
for $750,000, this one for $2.15 million, and this one for $1.2 million. They'd stay operating as Marsh stores, but they'd now be paying a lease while Sun Capital would collect an unspecified commission on the sales. It
is funny to think that a company needs, like basically a local Ohio grocer needs a private jet for their executives. It's a fucking Taylor Swift jet set around Ohio and Indiana.
Even went as far as selling the company headquarters for a reported $28 million before then straddling the grocer with a 20-year lease, increasing on a 7% clip every 5 years. This maneuver is called a sale leaseback, and it's quite common in private equity because, at least on paper, it makes sense for both parties. Marsh supermarket properties were no exception, as they could boost dividends or provide capital for another leveraged buyout for Sun Capital, while also helping the grocer to pay down debt and provide investment flexibility in the short term. But as for the consequences accompanying that long, escalating lease on company headquarters, along with cost-saving moves like carrying name brand products, cutting staff, and contracting out more and more services, well, Sun Capital just hoped it wouldn't have to deal with them. As of early 2009, news bubbled to the surface that they were trying to sell the grocery chain. But to the dismay of Sun Capital, the new, leaner, streamlined Marsh just wouldn't sell. Ultimately, the new owner business boost was short-lasted, and in 2017, the grocer would go out of business with Sun Capital at the helm until the very day it filed for bankruptcy. To Sun Capital, failing to sell was a missed opportunity and a company overhaul that they would deem a loss, as the group ultimately came $500,000 short of recouping their investment into the chain grocery store. But
private equity lost $500,000 over a year by bankrupting a grocery store? That is fucking tragic. And they say rich people don't feel the pain. By God, dude. 500 grand down the drain? Think about their company check.
Even in a loss, the private equity firm won. They still collected their management fee each year of ownership, after all. They also collected their commission on sold assets as the company spun off its property at seemingly every turn. Really, the only loss was that they just didn't win more. The same couldn't be said about the consumers or employees, though. Deeply embedded in Indiana and Ohio's urban areas, Marsh locations provided healthier, fresher alternatives in areas at risk of fading into food deserts. Beyond nostalgia, residents who lost their local grocery and pharmacy were mad, confused, and lost with the disappearance of a longtime local institution. Then there were the people that worked for Marsh. According to Washington Post reporting, at the onset of Sun Capital's ownership, only 1 of 3 retirement plans was agreed to be fully funded by the new ownership. Unsurprisingly, the executives plan. As for store employees, their pension went underfunded by some $32 million, which fell not on Sun Capital to even out, but to the government insurer. As for warehouse workers, Marsh owed some $55 million at the time of bankruptcy to their pension, which was already struggling to pay out full checks. Ultimately, Marsh Supermarkets as a business and Sun Capital as a private equity firm are relatively small potatoes. But their ill-fated 11 years speak to a larger pattern in American life. Private equity quietly maneuvers, takes over, reorganizes, and moves on while consumers and employees grapple with the consequences. Private equity fixates on industries, regional grocery chains like Marsh, casual restaurant chains like Red Lobster, odd-end industries like animal retail and veterinary care,
all of which they made worse.
Most unnervingly, the most consequential industry of them all, in healthcare. In most cases, only the sharpest-eyed consumer notices the subtle changes, but frequently enough,
I don't feel safe without a middleman between me and my doctor. And ideally that middleman comes from private equity. Do you know what I'm saying? I don't know if you guys feel the same way, but like, there's just no way I could have a business where I am just giving a doctor money to take care of me. There needs to be someone else involved. And ideally someone who lives far away and whose main concern is squeezing every last dollar. Ideally multiple middlemen, but
private equity's internal tinkering turns
Wall Street needs
sideways.
to be involved.
The local market goes out of business, the menu items
track
upward in price, the understaffed and overpriced veterinary clinic's care drops in quality, the elderly home staff unintentionally neglects a call for help. All this happens in the name of efficiency gains, cost-cutting, and corporate streamlining. Bad outcomes not even private equity firms can deny. On average, headcount at public companies bought by private equity shrinks by 12% over the following 2 years, translating to thousands upon thousands of layoffs. PE-owned nursing homes see 11% higher mortality rates than the non-PE-owned counterparts.
And it's cooler when they have 11% higher mortality rates and on the side buy life insurance policies to gamble on their lives. It's a double dip. It's a fucking double dip.
Coming to a total of 1,000 excess deaths per year. Companies acquired by private equity firms through leveraged buyouts are found to be 10 times more likely to go bankrupt in the following 10 years than those that are not. Theories abound as to why a benign structure leads to such malignant results, but none are surprising. They all have to do with what happens when one shrinks a conglomeration of hundreds or thousands of people, their relations, their creativity, their capabilities, their faults, their everything down to a deluge of figures on a spreadsheet. The stories of a private equity firm going in, working on the human level, changing the fundamental culture of a company in a way that strengthens collaboration, creativity, innovation, towards the end of just creating a stronger, more competitive product for their customers are tough to come by. The stories of a private equity firm going in, hiking pricing after their analysts told them that they could, hiring lobbyists to create more favorable legislative conditions, initiating mass layoffs for divisions that are not yet profitable, saddling companies with debt and complex financial maneuvers, shuffling assets around to create the illusion of transformation, sacrificing future potential for present-day returns. Those stories and their calamitous human results go on and on and on. Exploitation is easy without emotion. When the person making decisions is the same person unlocking the door each morning, it is much more difficult for them to profit off of their employees' suffering. They have to face the consequences of their greed face to face, and that's uncomfortable. When the person making decisions is the boss of the vice president whose senior associate manages the associate who sits on the portfolio company board who appoints the CEO whose direct report manages the division whose vice president manages the regional manager who oversees the branch manager that unlocks the door each morning, exploitation in the name of
I mean, this is true, I guess, but this is not where I see the flaw, which is that it shouldn't be on like the local grocery store owner to look him in the eye and be a good guy to make these decisions. It should be that if you take a business and run it into the ground, you should not somehow profit off of that. It is a flaw in discovery, in our legal structure, in our lobbying, in our, like, their ability to do a bad job and then make money by siphoning cash out of the business is the problem. If they were, you know, greedy fucks, but in a system with the right incentive structure, then the most greedy thing they could do is grow the business. But instead, there's a way to win without the company winning, which is, that's just fuck. That's just like, that's a fuck. That's the real problem. I don't like when the lesson is always like, they should have been more moral, because that's like, this system will only work until we get somebody in charge who cares about getting a lot of money. Oh wait, that happens every time. That happens every single time. We're never going to get a system where all the ownership of business is done by like the fucking nicest person. But the problem is the Skamaz setup where they can do a bad job and still squeeze out all the cash.
A profit is easier. And those small number of individuals at the top, the general partners, have all the incentive in the world to exploit on the margins. Because the compensation model, the industry is focused on growth at all costs. After all, without gangbusters growth, the person whose name is on the sign doesn't get paid. And finally, with a massive 20% of over-hurdle performance multiplied by leverage then paid out to the firm, tiny margins of difference, say outsourcing HR to a third-party firm that is less effective yet cheaper, make all the difference on the general partner's annual income. The incentives push towards brutality. Then this brutality is shielded by layers of bureaucracy. And finally, the US government rewards the brutality by subjecting the gains from it to a lower tax rate. It's a great system, assuming you happen to be the general partner of an American private equity firm.
Most of us are, right?
As you may know, the latest fixation of the finance world, even beyond just private equity, is artificial intelligence. Many investors believe that it's as groundbreaking a technology as the internet, and
That's an ad. Yeah, very interesting. I've read, I mean, there's a book called Plunder that I have recommended, even though it's pretty depressing. Private equity makes me generally upset and angry, and there's a myriad of flaws with it, but I think most notably is just a real perverse incentive structure.